Hi there. My name is Bill Scott. I was president of ITC Holding Company in West Point, Georgia from 1988 until 2003. Over that period of time, we made about 55 different equity investments in various types of companies. Many of them were telecommunications, but many of them were internet related, and also maybe a few other types of investments as well. And I've been asked to share some of my views on small businesses raising equity capital. Equity capital, most people don't realize, but it's probably the most important foundational component of a business. Many businesses fail because they do not have sufficient equity capital. There are many places to get equity for your small business. I view probably the three main places to get it are from friends and family, second from what's called angel investors, and then third from what we would call traditional venture capital types of investors. For most small businesses, probably that need less than $1 million these days, money would probably have to come from yourself and from friends and family. It's tricky to be in business with friends and family, but that's the easiest place to raise money. Angel investors normally invest perhaps as small as $1 million, or groups of investors. There are angel investor groups around, particularly in the Atlanta area. They might invest with you. Their expectations are very similar to venture capitalists, but true venture capitalists probably are not interested in investing less than several $1 million, maybe $5 or maybe $10 million. What does a venture capitalist expect? In addition to a well-run business, they expect a return on their investment. That is the key driver for traditional venture capitalists. In fact, it's the key driver for angel investors as well. They will very carefully analyze your business plan and how you value your business, and to determine whether they can make money or not. A typical venture capitalist would require at least a 35 or 40% return annually on their investment. I call it the 5 by 5 rule. They expect probably 5 times their money in 5 years. So if they invest $1 million or $2 million or $5 million, they would need to have your business grow where it was valuable enough, where their portion that they bought would be worth 5 times what their original investment was worth. This seems like a lot, but as I mentioned earlier, during my career at ITC, we invested in some 55 investments, but probably only 10 of those made significant money. And when you're looking at those kinds of odds for an angel investor or a venture capitalist, you can see why they require 30, 40, or 50% return on their money, so that overall their blended rate of return on all of their investments is north of, say, 20%, because equity capital does require a high rate of return.